Gold and silver are not merely declining. They are being systematically annihilated in a way that defies every natural law of supply and demand. This is not a correction. It is a structural freefall happening in real time. As I speak, gold has plunged below 4,600. Silver has shattered the $72 mark, a level that was supposed to be an impenetrable floor. Every few minutes, the figures drop further: 45.50, 45.20. There is no pause. Friday was expected to mark the absolute low point, with silver falling 38% and gold 16%. Most traders believed the worst had passed. They were wrong. What we are witnessing is panic liquidation, forced disposals, and margin calls rippling across the system. Traders are being eliminated trade by trade. This is an active collapse unfolding live, but to the untrained eye, it looks like a sell-off. To those who know where to look, it looks like a crime scene. To understand why this is happening, you have to look at the mechanism of destruction. This crash is being driven by margin increases. In futures trading, participants post a deposit to manage massive exposure. When the exchange suddenly raises margin demands overnight, you must supply additional funds instantly. Without immediate cash, the exchange automatically closes your position at the disastrous prevailing rate. A single margin adjustment can be endured. But 8 increases within 8 weeks? That is deliberate destruction. That is precisely what the CME implemented. 8 margin escalations across 8 weeks, specifically crafted to extract liquidity from bullish positions. They hiked them during the holidays when liquidity was thin. Then, on January 13th, the CME shifted to percentage-based requirements. Now, as silver prices fluctuate, margin obligations automatically expand. It is a self-tightening snare. By contrast, the entirety of 2024 saw only 2 hikes. We have seen 8 in 2 months. This is an engineered downward vortex. But here is the detail that exposes the collusion. On the exact same morning as the latest CME action, the Shanghai Gold Exchange raised its margins from 20% to 26%. Chicago and Shanghai, usually locked in geopolitical disputes, acted on the identical day, in the identical direction. The United States and China rarely align on anything. Yet on silver margin policy, we see perfect synchronization. That alignment only occurs when both sides fear the identical threat, a delivery default. The paper-to-physical ratio on the COMEX stands at 356 to 1. For every genuine ounce stored, there are 356 paper claims. This structure works when settlements remain financial. But when physical delivery is requested, the equation collapses. And right now, requests are surging. During the 3rd week of January alone, 33 million ounces were withdrawn from COMEX facilities, physically collected and permanently removed. That represented 26% of total holdings in a single week. 4 years ago, COMEX warehouses held 430 million ounces. Today, only 113 million remain. 74% of the inventory has evaporated. March is pivotal. March futures contracts promised delivery of 528 million ounces. The warehouses hold 113 million. Nearly 5 times more silver has been committed than physically exists. First notice day falls on March 27. If only 22% of contract holders insist on physical delivery, the vaults reach 0. This is the catastrophe both the CME and Shanghai seek to prevent. The coordinated margin escalations are a desperate attempt to force bullish positions out before delivery obligations, reveal the system's fragility. The strategy is succeeding. Bullish participants are being eradicated. Yet here lies the clearest proof this collapse is artificial. Compare 2 benchmarks. COMEX silver, the paper quotation, is at $72. Shanghai silver, the physical quotation, is trading at $100. That is a $28 disparity. Identical commodity, identical date, yet a 39% premium for tangible metal. If silver were truly valued at $72, why do knowledgeable Chinese factories pay $100? They recognize the paper quotation as fabricated. They know the genuine worth aligns with the physical transaction price. The beneficiaries of this distortion are clear. JP Morgan maintains the biggest short exposure in silver in recorded history. Bank of America and HSBC also hold substantial shorts. These institutions participate in CME governance committees and possess detailed insight into market positioning. On Friday, Ordinary participants suffered 38% losses while these banks recorded billions in gains. The timing is too perfect. On Thursday evening, a Reuters report alleged the US government would cease backing strategic metals, triggering algorithmic sales. The story was retracted hours later as fabricated, but the damage was done. Simultaneously, a hawkish Fed chair nominee was leaked. Fabricated reports, leaked nominations, 8 margin escalations, all clustered in the same period. Additionally, unusual options volume appeared in silver ETFs the day before the plunge, with heavy purchases of puts. Someone knew this was coming. Those attempting to escape found no path. In China, the UBS SDIC Silver Fund was suspended entirely. In the US, ProShares Ultra Silver lost 62%. But price erosion was not the primary hardship. Sell attempts failed. Platforms displayed errors. Support lines reported waits exceeding 2 hours. One participant described 18 continuous hours attempting to exit a futures position, watching losses mount with no control. The sequence is telling. Crash the value, seal the exits, impose further margin demands. Fundamentally, this drop defies logic. Silver has operated in a structural shortage for 5 straight years. Solar panels, EVs, and AI components consume it faster than it is mined. The accumulated deficit since 2019 totals 1.3 billion ounces. Then, China imposed export restrictions effective January 2026, instructing Western buyers to locate alternative sources where none exist. The damage extends beyond traders. In Rajkot, India's jewelry center, 44 companies filed for insolvency last week, with $425 million in losses. In London, hedge funds paused withdrawals because silver holdings are underwater. In Dubai, physical premiums sit at 15%. The fallout spreads throughout the global financial network. Connect these elements. A 5-year deficit, accelerating consumption, export controls, yet prices collapse. That contradiction only resolves if paper quotations are intentionally depressed ahead of March delivery. I maintain that physical metal ultimately prevails. Paper obligations can expand without limit. Physical metal cannot. At present, paper dominates. But monitor the indicators. The Shanghai premium remains firm. Lease rates hover at 10%, 20 times typical levels, indicating institutions urgently seek tangible metal. Vault withdrawals persist. While retail panic sells, March contract open interest stays elevated. Participants cling to delivery rights. The core conditions remain unaltered. Only paper quotations have shifted, forced lower via artificial pressure. Eventually, paper must align with physical reality. Collapses do not erase wealth, they redistribute it. Friday transferred capital from retail to institutions. When the reversal occurs, the flow returns. The critical question is your position when that shift happens. Paper at 72, physical at 100. That spread must eventually converge. Profits await those correctly positioned, but only if they can survive the engineered vortex designed to wipe them out.